We're going to today film this video is going to go over one of our newest and coolest indicators. We call it Doomsday by code word. It will be released with a kind of different name, but Doomsday is a nickname. It's kind of stuck. And we're going to go over what it does today. Doomsday is a ratio. It'll be between 0 and 1. And what that number is an exploit of the risk intervals. It's something that we have been working on for a very long time. The risk intervals are a number that are given to you by the bot in our Discord. And the risk intervals create a band where volume pivots will appear in the futures market, which helps me trade SPY and other things. So how does this work is really neat. So in the Rocket Scooter platform itself, the DD ratio is printed at the top at the time of this video, and DD bands will be drawn on the side of SPY, or when we do have futures in the platform, will be drawn on the futures chart itself. And that's coming very soon in the coming weeks. In the classic app, you will see that this DD number is shown right here to the next to the right of resilience at the bottom of the classic app as well. So the ratio is all that you need to know. Whenever the platform gets all the data that comes through, it will show DD as one calculation that doesn't change. When that calculation is printed, it opens up a whole new mechanic to our trading and pivoting the market. DD is actually one of the things that's considering rationality in the market. So when it comes to irrational markets, I'm going to go ahead and bring this right on the screen. If you guys remember, Trading Strats channel in our Discord, irrational markets cause me to sit out, and Doomsday band is one of the things that tells me that the market is irrational and to get out of the way. And so how this works, we had a bot in our Discord and the Doomsday bot channel that's now going to become obsolete because it's going to be in the platform, but essentially has the rules there. And it's that if you open at 9:30 in the morning, which is the equities market opens, the value of the S&P futures, and we just do it on S&P, nothing else. If the value of the S&P futures are in between a range of bands, or a range that's set by the bands, then at least once in the session, which means all night until that morning, if that ratio is greater than 1/2, you expect it to touch the upper band at least once. If that ratio is less than half, you expect it to touch the lower band at least once. So what does that mean? I'm going to draw it in Thinkorswim, and I actually made an indicator in our community. Our lifetime members had made this for testing purposes, so it's about to become obsolete. But this is the band, and I'm going to open S&P up and just show you. It's the green line band inside of this chart. And you see that when the market is trading inside the band, it likes to stay inside the band. Inside the band, it likes to try to stay even if it breaks out. It likes to pivot at these levels. I could show you on a kind of like an intra-hour chart. We're going to go to maybe a 5-minute and show you that when you hit those bands, there are volume pivots there. And we're actually hitting one right now, but you see over yesterday's session, there's volume and volume and volume. It's just another calculation that predicts volume. So what creates this band is that at the end of the day, the Globex session closes. It's 5 p.m. Eastern. From that moment in time, the band just draws a line above and below over the distance of the whole session, the distance of the risk interval. What is the risk interval? At this point in time, it's not in the Rocket Scooter platform itself, but the risk interval bot in the Discord will have those numbers. Every Sunday, we update them, and that number says 27.5. The green line videos in Rocket Scooter will detail what green line exploits very much. So there's a lot to learn from those. So I'm going to skip a lot of it now, but just letting you know that from the Globex session, there's a volume pivot against the high of 27.5 and a volume pivot against the low. You see them right here. There's a lot of volume against these, and I'll just zoom in and let you see it. It's pretty easy to see if I kind of zoom in right here. Let's just kind of zoom into there, get that scale. So as you're, even in the overnight session, as you're passing through that band, so there's a huge volume. It's like relative. I mean, it's 3 in the morning. Relative, to the overnight, it's a lot when you're trading, 1,000 or less candles every 5 minutes, and you jump to about 5,000. That's a big deal. And you see that just volume comes in each one of these. And even during the opening of our market, there is also volume at the same band as well. So the DD rule states that if you open inside the bands today on S&P, we did. We opened at 930 inside the band. If you open inside the band, if that DD number is greater than half, you expect it to touch the upper band at least once in the session. Now, today is FOMC day, so barring a catalyst, which in our Discord supersedes the DD number, if you go back to trading strats, an index catalyst trumps all. So with FOMC coming up, I'm not really doing much or expecting much during the session. But pretending it wasn't FOMC, if this falls down to this lower band and that DD number is greater than 1/2, which it is, today was a 0.64 if you remember from the platform, I expect it to want to touch the upper band at least once. So if that trade hasn't happened yet, then I'm already looking at it as a potential trade to take. An example here is that pretend that DD was greater than half, right? And I expect it to touch the band at least once. Well, it already did in the overnight session, so it no longer applies. It's not a rule anymore. Whenever that band has been touched at least once in agreement with the rule, if DD is less than half and it's touched the upper band, I still expect it to touch the lower band at least once. Just at least once. And we never bet on it twice or 3 or 4 times. Once it touches, it's done and it's over. So here, if that DD band was less than half and we rallied, my idea would be that I would know that the market wants to tap at least the bottom. So if I was a bull, I would wait for a lower low to long from, or if I was a bear, I would short up here to tap that band either way. Once you touch it, the rule no longer applies. Rule number 2, if you open outside the band at 930, the rule doesn't apply ever, period. So today we opened inside the band. Yesterday we opened inside the band. The day before, open outside the band, and the rule doesn't apply. You just ignore it. So in the cases that you open inside that risk interval band, you can use DD to pivot that range for scalping. It's really good. And the last rule to take from this is how Doomsday can be used as a flag of irrationality to sit out. If you watch our video on the irrational market with our stop rules, you will see that Doomsday is one of the irrational signs. There's 5 rules we have that tell me to get out of the way. Anytime you're outside the Doomsday bands, then the market's irrational. And irrational markets get out, stay out, sit out, enjoy your day. So when you are trading down in here, strategically, I tell myself, I'm just going to sit out. The market opens outside the band, I sit out. Now, if you push inside the band, the market's technically rational again, but still, I don't like to trade from outside the band or inside the band and continue the trade unless everything else looks stable in the market, like we get a bull long up or a short squeeze or something looks good. The market's mean reversion or short or anything looking bad and we're opening below the bands, I just don't play that day. And another thing is if I'm inside the band and what happens if you break out? See, you don't really, if I'm saying I'm shorting the market here on this day, and the market hits the band and breaks above more than 1 strike distance. For me, it's 10 points in the S&P, 1 point in SPY. If you go more than that distance here, it's better safe than sorry. I need to get out of the way because sometimes you can create a squeeze, especially on expiration day, that can really just take, it can just kill your account. Better safe than sorry. So sometimes when you break that irrationality band, it will just crash on itself and sometimes it'll come back in. Statistically, we've done the measurements, statistically, we've done the empirical analysis of all the data, and it's just 100% random. It has to do with probably the liquidity and risk of all the participating traders. So sometimes if you go outside the band, it'll try to tuck back in. Sometimes you go outside the band, it'll tuck back in. If it goes at least 10 points outside the band, it's better safe than sorry. So again, 10 points out of the band, 37.30 to 37.40, I'm out of the way and I avoid another 40-point move, even though it tucked in. Being outside the band, irrational market says get out, stay out, and get out of the way. And look at the markets just doing nothing. And your options are going to lose premium. You're going to long at the high, short at the bottom, and both of you are going to lose. The idea is when you're outside the band, unless you're already in a trade, unless you get a hedge pressure break, hedge pressure bounce, or a resilience flag to tell you to go, you don't bet that markets break irrational and keep going. They can break irrational and then sell back off. Like the market is random outside the band, but inside the band, those volume pivots are very much active all the time, and there's good trades. Like this is a great example of a DD trade. It's a scalp when the market's flat. Here, when the market's flat and outside the bands, notice that it's unusually volatile. As a matter of fact, the range gets wider as the day progresses. So does this, but not as much, right? The distance between here is 37.80 and 36.37. It's an 80-point run. 36.90 to 37.45. It's about a 60-point run, right? Inside the band, the volatility is less. Outside the band, the volatility is more, and that's what you can come to expect from that type of play using DD. So it's a great tool to use to understand how markets are rational or irrational. This has to do with the probability of margin calls of participating market makers and institutional firms. And so outside, at the edge of the band, there's just a lot of hedging that takes place. And whenever you have, again, a catalyst like today, you can expect that the catalyst is going to supersede the DD. So in this market, DD is greater than half. And so potentially if there was no catalyst, right, I would long right here to get that volume pivot. And actually it's happening right now in this video, which is really neat to see. So let's go ahead and zoom into that risk interval band. And as you see right here, there is a little bit of a volume spike as you approach it, which is nice to know. The average volume about 1,000 and it jumps to about 3,000. There's a 300% volume increase at that level. If FOMC pushes the market lower outside the band, I don't do anything at all outside of this band. So that is how Doomsday works. It's really cool. It's one of our favorite new indicators. How it's constructed is proprietary, but what it does is it's looking at a distribution of risk of all the stocks in that index and seeing what their positional risk is. It's using walls on all stocks in the S&P and coming up with a number that's looking for bull or bear bias against all the stocks. So it's a really neat indicator. We're glad to share it with you guys. It's a new fan favorite. It is talked about every single morning, and it's one of the 5 checks I do in my pre-market checklist, my little 10-second risk management checklist. Check that video out right now, and we'll walk you through that Doomsday is one of my checks to make sure market is rational.